Sambre is with us. He's head of equities at DSP Mutual Fund. Vinit, good to have you with us here. Good morning. Just wanted to get a sense on the telecom space. What else? A lot of action there. The revival of the third player, which was always there, hanging at the margin, but now, equity infusion, bank lines opening up post the completion of the FPO. What does it mean, and what kind of investment opportunities does it open up, to your mind?
So I think clearly the whole sector actually has seen the revival after this, big shift which is there. I mean, earlier the doubts were cast whether the third player will survive or no. And even today, when we look at the balance sheet of the third player, I mean, things are still up there for them as a challenge in terms of bringing down the overall liability. But now with the fundraise, with the intent, it seems that they will survive. And more importantly, I think what for the sector as a whole, the most important matrix which looks like improving going forward is the ARPU level, which has been slow in terms of the historical changes in the past. So I think if that moves up, it brings about a positive change for the sector. The sector generally becomes more cash flow positive. It helps all the players in the sector. And also in terms of the incremental balance sheet, just to mention here, in the past, these companies have struggled from the free cash flow perspective, and those little bit changes which drives the re-rating for the sector. A large part of that re-rating maybe has already happened. Maybe some bit is still left, but I think interesting times for the sector. It looks positive incrementally is what I can say.
Okay, interesting times for the sector. Vinit, hi, good morning and good to see you after a while. How are you feeling about the market, especially the mid and small cap space? Has the time come to become a bit cautious now, or do you think that one should continue their allocations to mid and small caps? I'm asking because of the kind of run-up that these stocks have seen.
No. So I think you're right. Incrementally, even our advice to investors has been that if one has to allocate in terms of the asset allocation, it has to be through the SIP route because we are at the high point. And also from the whole thesis that the last let's see, if we just consider the long-term picture, last 5 years, just to remove the COVID anomaly in between, the last 5 years has seen significant change in the earnings across the board. The large companies have grown at a CAGR of 15-16%. The mid and small companies have grown at a CAGR of 20+%, and that has got reflected in the stock price changes as well. So I would say from here onwards, maybe we are hitting a point where the earnings maybe see some consolidation over the next 1 year. Given that there is bit of a slowdown across the board in terms of consumer names or in terms of the IT names. So I would say there is some bit of that slowdown fear which is there. The margins which were improving for the sector for across the board, I think with the commodity prices again flaring up could become a challenge. So I would say that we are at a high point in the valuations. There is some bit of consolidation or moderation in the earnings likely over the next 1 year or so. And hence it makes a case to be slightly more conservative as far as a large allocation is concerned. Maybe an SIP, as I said, is a better way to approach the segment.
Okay. Hi, Vinit. Good morning and good to see you in. Vinit, what about this metal super cycle that the street is waiting for? Stocks are flying away. They are factoring in, I think, a super duper cycle because the way the stocks have moved. But how are you all playing this theme? I'm just looking at iron ore prices in Singapore that's traded. That saw a sharp correction. That's bounced up 4-5% this morning as well. Any of these themes you like, whether it's ferrous, non-ferrous, I'm not sure whether you can name a few stocks. But maybe, in fact, no, there are pockets still where there is going to be a deficit globally. And if the Fed cuts, then the dollar index as well will cool off, which normally is positive for metal stocks. How are you approaching this theme?
So I think, Nigel, first of all, there's too much of noise and euphoria. And generally, if you see the rally has been very coordinated. You have all type of asset classes doing well right now. Your equities is doing well, the commodities are doing well, gold, precious metals, even the dollar index is actually strengthened, and this is something which is contradictory. So I think the historical correlations are not working here, and hence and generally my sense is that always in euphoria is where sometimes people tend to get it wrong, and hence where there is huge amount of trade happening, consensus trade. I think one needs to maybe be more clear about what one is really looking forward to. The best way to actually approach the metal sector has always been when on the price to book valuations, the businesses tend to give some kind of upsides. Today, I think the euphoria is on the high side. Maybe it sustains because of the momentum, but I'm not very clear about the investment into these in a big way as of now.
The other space I just wanted a quick word in was the defense space, if you will. Again, here the stocks have done well, then went into many months of consolidation, but the size and scale of the move was humongous. There's no doubt that defense spending around the world is at an all-time high. The thing which changed here a couple of years ago, of course, was sort of import substitution in a large way. So the triggers are there, but what about valuations? What do you own in that space, if you will? If you can't talk stocks, if you can talk about segments, Vinit.
So, Prashant, what we are doing is that what we are owning, we are not selling. I mean, we clearly understand that the valuations have come to a high point in their lifetime history for the defense players. And largely, we all know that these are within the PSUs as such overall. But I would say that the opportunities there, we believe that these companies are seeing order coming in, which is much higher than the anticipation, their own anticipation, in which gives us some kind of insights that these, as they start recognizing them in revenues, I think the revenue should also surprise on the positive side. Like you mentioned, I think the exports is opening up as a big opportunity. Just 5 years back, maybe we were exporting 4,000 odd crore in terms of the defense. Today, we are exporting 25,000 crore, and the target is that we will export 50,000 crore. So I would say that the opportunity seems to be big, reasonable. The valuations are on the high, and hence I think while one can remain positive on the basis of the anticipation of good growth, but one needs to also consider the valuations. Maybe at some levels where it comes down for whatever reasons, I think it could be a good point to keep accumulating till the time the business outlook looks good.
Okay, got it. By the way, a lot of stocks are actually moving up. Even in the auto space, Hindustan Motors is up almost 8%. It's doubled this year. Just pull up that stock. Jamna Auto is up almost about 4 odd %. It's had a very strong run this year. And a couple of other auto names also picking up pace. Vinit, I wanted your thoughts here, especially for auto ancillaries, right? There's this huge potential in the EV space globally, especially after what Hyundai and Kia did, where they, they outsourced their sort of battery making to a player like Exide. So now everyone's talking about global OEMs outsourcing the EV opportunities to auto ancillaries in India. Do you see that as a major potential? And if yes, which are the pockets that investors should be looking at?
Yeah, so I think we believe that this is going to be a decent size opportunity over a period of time. But what we also recognize clearly is that there has been, and versus the expectation, I think the EV acceptance has been much lower in India and globally also overall till now. And hence, I would say that while the opportunity is large, but one will have to maybe on the timelines, it is possible that one can go wrong. So that is the one caveat. But the way we have sort of played this, and I've mentioned this in your channel, that we have looked at auto ancillaries a better way to play the sector, because it is very difficult to capture whether the two-wheelers at a point in the cycle will do well, or a passenger vehicle or a commercial vehicle. So I think we thought that auto ancillary is a better way. And within that, I think, Sonia, I agree that we have to be technology neutral. We have to look at companies which would be supplying to all types of segments, EV, ICE type of engines. And I think that should continue. And the only last point I want to mention here is that, the auto has seen a good recovery after COVID. The last 5 years, the earnings has CAGRed at 45-50 odd %. I believe that they, again, with my similar thoughts on the markets, I think for them also, maybe they see some bit of consolidation going forward. And hence, I think auto ancillary should sort of remain a better way to capture this upside over the next 3 or 4 years.
Okay, all right. Thanks a lot for that. Auto ancillary is the big space to look at. And of course, we'll talk about the auto sales and auto earnings as well through the course of the next 1 hour. So do stay tuned in for that. But telecom is clear.